Good Friday morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Stock futures gain on signs of a thawing in the US-China trade standoff. Beijing says it is evaluating direct talks with Washington. Cloudy forecast. Amazon says it is bracing for a tougher business climate in the coming months, while Apple slumps in late trade on slower sales in China and a warning on tariffs. Plus, Standard Chartered reports a first quarter profit beat driven by its financial markets and wealth units. I'll be speaking with the bank's CFO later this hour. We will break earnings from NatWest and oil giant Shell. European markets set to reopen after the holiday yesterday for most of those markets with a bang then. Set for 8 straight days of gains if the futures turn out, of course, to be reflected in the session later today, pointing up by 1.4%. So you could end Friday with 8 straight days of gains for European stocks. US stocks have already gone through that cycle. They are set now on US futures for 9 straight days of gains. That would be the biggest winning streak we've seen for a number of years. And we'll get the context from Valerie Teitel, who's going to break that down for us. FTSE 100 futures currently pointed gains of 0.6%. We're looking at some local elections in the UK as well, so an eye on the pound. S&P futures stateside looking to add 0.8% despite the disappointment coming through for the likes of Apple and Amazon. So the tech trade, some question marks there. When it comes to the Nasdaq 100 futures, despite that, looking up as well by 0.6%. It seems like the rhetoric around trade is more squarely in focus. Let's flip the board and have a look cross asset. We do have the macro data, of course, and the focus on non-farm payrolls. That print out later today. Unemployment expected to remain at 4.2%. Watch the hourly earnings, though. That could be important as markets continue to assess where the Fed goes from here in potentially a higher inflation environment and possibly some cracks in the labour market. 422 right now on the benchmark 10-year yields moving just 1 basis point. Euro dollar at 113, gaining on softer dollar, just up 0.1%. Brent in focus again, some additional threats coming through from the Trump administration around Iran and oil there. $62 a barrel on Brent. Gold at 3,249, up 0.3 after some selling pressure yesterday for the yellow metal. Briefly checking in on the Asian markets. The lift is coming through then on the lines from China, hinting, signalling, suggesting that they are inching closer to some kind of conversation with the US about this trade war. Broadly across the benchmark, you're seeing gains then in Asia of 1.5%. Mainland markets are closed in China. The HSI index, though, reflecting that optimism, up 1.7% in the session so far. The Nikkei in Japan up 1.2%, and the Japanese yen largely unchanged, 145. The BOJ yesterday, of course, and the commentary. Let's get to the details then on what China has been saying. Says it is assessing now the possibility of trade talks with the US, citing senior US officials' willingness to discuss tariffs. Speaking on Fox News, US Secretary of State Marco Rubio says China wants to come to the negotiating table.
Can we reach some sort of short-term accommodation with them? That's what they want. I mean, the Chinese are reaching out. They want to meet. They want to talk.
Bloomberg senior editor Bill Ferries joins us now. Bill, let's start on what we've been hearing from China. What do we read into the China messaging now on these potential beginnings of some form of talks around trade?
Yeah, you really do have to kind of read between the lines here to see what exactly is China saying, and is it that different from what they've been saying before? The market certainly seems to be reacting to this statement that they're assessing the possibility of talks, although China went on to say that they still need to see sincerity from the U.S., and it seemed to reiterate their position that the U.S. needs to roll back what it considers to be the tariffs that were put in almost a month ago now. So it's not clear to me whether the Chinese are responding to comments that are being made behind the scenes directly between maybe lower level officials, or if they're simply responding to some of the comments we've seen from people like Marco Rubio, from Scott Bessent, saying that there is interest in talks, although those officials are usually quick to say they want China to be reaching out first. That said, it does seem to be there does seem to be a little bit of light in the tunnel at this point. It's just not clear how far off it is.
Well, we do know there are talks. If we're not so sure on what's happening in terms of China, maybe the signalling is there. But we do know there are actually concrete talks now taking place and have been for a number of days, a number of weeks between Japan and the US. And it seems there is real progress there. No deal yet, but it seems there is at least some pretty concrete measures that have been put in place to get to that point.
That's right. I mean, Japanese officials signaling that they would like to see the talks that have been taking place so far accelerate. Beginning in the middle of May. There is a good chance that the Japanese and U.S. leadership will be at an international summit in June, so there's a reason to get those talks moving ahead. U.S. officials have always said that they think Japan as well as India are at the top of the list. The big thing here, though, is that whatever the deal means for Japan, it's going to be looked at as a model for all the other countries trying to get some sort of an agreement in place before that 90-day reprieve ends expires at the end of July. So there's a lot riding on that first deal, and there's going to be a lot of interest in how much of it is about tariffs, how much of it is about non-tariff barriers, and how much maybe is just about investments in the U.S.
OK, Bloomberg senior editor Bill Ferries, thank you very much indeed. With the European Union as well putting forward their proposals, and we'll see what the response is from the Trump administration to the EU's latest overtures. Meanwhile, from the top line in terms of the tariff discussion to what is actually the impact right now at a corporate level, because we got some detail and some colour from Apple and Amazon with their earnings, of course. Both companies slumping after their latest quarterly reports failed to quell those investor concerns about tech and tariffs. Speaking on the earnings call, Amazon CEO Andy Jassy addressed the current trade uncertainty.
Obviously, none of us knows exactly where tariffs will settle or when. We haven't seen any attenuation of demand yet. To some extent, we've seen some heightened buying in certain categories that may indicate stocking up in advance of any potential tariff impact.
Meanwhile, Apple's China sales disappointed, and it warned of damage from the trade war. Bloomberg's Charlie Wells joins me now. Been looking at both companies' results and, of course, the lens on what is happening in terms of the impact of tariffs and the trade war. Let's start with Apple. What did CEO Tim Cook have to say about the tariff impact for them?
Not good things, Tom. So, everyone cares, about the prior quarter, but they care even more about the current one.
Yeah.
And what Cook said yesterday was that tariffs could hit the company to the tune of $900 million. And that is not what investors wanted to hear. And I think what investors also didn't want to hear was about this softness in China, right? China is such an important market for this company, not just because of the production. And we know production is under strain because of this tariff uncertainty, but also on the sales front, right? It's the third most important market there. They've seen a slowdown. This used to be a growth market, but sales were down 2.3% on the back of AI kind of lag, and just the fact that they have so much more competition from local smartphone makers now. So not great for this firm.
I mean, Chinese smartphone makers, Xiaomi, Huawei, they've had foldable phones for 5 years. Apple says it's going to have one on the market in China, in a year's time or something? They don't have a real AI story to tell in China either. But there you go. There's the number. Almost $1 billion from the tariff hit. That's just so far for Apple. What about Amazon? What did you read into this? AWS, disappointing a little bit. That's central as well. But the supply chain story important for Amazon.
The supply chain story isn't important. I think a lot of people have been talking about that, the tariff issue here. They rely, again, so much on China. But then also, the services part of Amazon is really important. So that AWS unit brings in a significant amount of profit for this company. And they saw growth, but it was slower growth than they've seen in the previous quarter, And that contrasted to some of the really strong growth in cloud that we saw at Microsoft yesterday. And so this kind of indicates that, again, there's just more competition in this space that could take a hit on the company.
You've been looking at all the tech earnings that have come through so far this week. It's a little unfair to put them all in the Mag7 basket right now because they're all facing different challenges, some performing and outperforming others quite considerably. And we've seen that reflected in the results today. What for you has kind of stood out in terms of how mega cap tech is performing?
This was always going to be the harder part of tech earnings season because it is the hardware or the retail side of that Mag7. We had really early, really good results from the more software leaning companies. And so I think just remembering that there is this diversity divergence that is emerging and that could continue to emerge if this trade uncertainty stays. I think that's something that investors are going to have to focus on.
Charlie Wells, excellent wrap of what's been going on in the tech space with the earnings coming through and what it tells us about the direct impact, of course, of tariffs. Charlie, thank you. Now, markets are welcoming that potential thawing then in the US-China trade standoff, with all the caveats, of course. Asian stocks and Wall Street futures then getting a boost this morning, as we mentioned. Let's bring in Bloomberg's Valerie Teitel right now for the size and scope. Val, what a performance for the S&P. 8 straight days of gains. We could be set for a 9th straight day of upside for the S&P 500.
Yeah, that's right, Tom. I'll try to temper my enthusiasm because I'm definitely feeling the bullishness of this U.S. equity market this morning. S&P 500 notching 8 straight days of gains, and take a look at the futures move. We might just be able to make it 9. We are up almost 10% now in the last 9 sessions, and this really could be one for the history books, Tom. Let's flip on and just compare how this streak compares to history, because if we end in the green today, that would be the longest streak for the U.S. equity market in 20 years. We have to go back to all the way to November 2004 to find a comparable run. And I don't want to jinx it, Tom, but the next superlative comes at 12 days. We have to go all the way back to the 90s for that. 14 days is the longest on record. That happened all the way back in 1971. So that's the setup for the equity market here. If we end in the green today, the longest streak in 20 years. But the streak has ended for the Treasury market. We had seen a solid pace of gains for the Treasury market that came to an end yesterday. We saw a surprising repricing in the front end. Those 2-year yields rose around 10 basis points in yesterday's session, Tom. But it was all down to good news. We had a positive reading on the ISM manufacturing component and some big strength in the new orders component, the more forward-looking component of ISM. So that strong data yesterday really starting to maybe us rethink whether we need those 4 rate cuts from the Federal Reserve this year. There was a lot of volumes going through in the Treasury market yesterday. We saw some decent block trades in the front end as we repriced the Fed's path forward.
Yeah, the next cut of 25 basis points not fully priced until July right now by these markets. We'll see how that adjusts. On the data today, non-farm payrolls, what are you going to be looking at in terms of the data set and whether or not we're going to see some real softness in the labour market?
Well, look, Tom, for this market, I think the risk is really for a lower print. I think the market is very much likely to shrug off a stronger print, just saying this was pre-tariff data. We're not going to give it too much weight. A lot of economists out there saying that this April's print could really be the last solid print for the U.S. labor market, expecting to see some labor market weakness because of the tariffs, but maybe not until the May or the June print later this summer. But we are expected 135K consensus for today's print. The unemployment rate is expected to stay steady at 4.2%. The Fed really does have their eye on the unemployment rate. If we do get an unexpected rise in the unemployment rate, perhaps that could soften Powell's language next week. The Fed does have a decision on May 7th. They are likely to stay on hold.
OK, Bloomberg's Valerie Teitel with an excellent setup there for the non-farm payrolls data coming up later today, which, of course, the team will break for you with the analysis through the US trading hours. Here's what else to think about then today before we get to that point. On the earnings front, 7 a.m. UK time, we're going to be breaking the numbers from Shell. All the volatility, of course, around the oil prices. Oil prices, what, at around 4-year lows right now, $60 a barrel. Citi saying you could get below $50 a barrel, depending on additional production coming through from OPEC+. So Shell earnings, a gauge, of course, on that demand picture and arguably on the trade story as well. Those numbers dropping at 7 a.m. UK time. At 10 a.m. we're going to get the euro area CPI data. So the inflation read across the euro area. That is at 10 a.m. UK time. Of course, the ECB is fully expected to continue its rate cutting moves through this year. Is the progress still being made to that 2% target for the ECB? So far, it has been on something of a glide path lower on inflation. 1:30 p.m. UK time. It is, of course, non-farm payrolls. You've had the setup there from Valerie Teitel. The look at average hourly earnings. The unemployment rate expected to remain on hold at 4.2%. Is that adjusted higher? And if so, does that change expectations around the Fed? Those numbers dropping at 1:30 p.m. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go on the terminal. Coming up, Standard Chartered profits beat. We're going to discuss the results with the bank's CFO. That is at 6:30 a.m. UK time. Stay with us for that conversation. Plenty more coming up between then and now. Stay with us. This is Bloomberg.
there's a core underlying structure of German banking that is not helpful to anybody trying to create a sort of a broader retail platform. And so I would be in favor of some consolidation, some bigger European banks. Some of the colleagues here might say, well, no, we don't want them competing. What are you talking about? But I think the pie will be bigger.
And that was Bernie Mensah, Bank of America's president of International, speaking to Bloomberg's Francine Lacroix, of course, making the call for more banking consolidation in the space. We've seen some moves around that in recent days in Spain, haven't we? Now, Standard Chartered on the earnings story, the latest bank to come through with their numbers, posting better than expected first quarter profit as it weighs the impact of US President Trump's trade war. Adjusted pre-tax profit then hitting 2.38, close to 2.4 billion US dollars, driven by the bank's financial markets and wealth units. For more, let's bring in Thomas Nerzel, senior bank analyst for Bloomberg Intelligence. Thomas, your key takeaways then from the Standard Chartered numbers, what it tells us about this very Asia, very Africa-focused lender, of course, and how well it's performing amidst all this trade tension.
Exactly, yes. So Standard Chartered, everybody was awaiting Standard Chartered results, given that they have very big exposure to trade revenues, around 7.43 billion in 2024. It's around 40% of its total revenue, 60% of CIB. So we are expecting to see some sort of direction on what can happen with trade income. Surprisingly, what Standard Chartered is showcasing us, very strong results supported by wealth and financial markets business. But what they talk more about opportunities coming from the trade and tariff risk rather than discussing downside to the revenue, which is a little bit different than what we have seen with HSBC, who provided us with sort of guidance what can happen in trade severe scenario to the revenue and what can happen to cost of risk. The Standard Chartered took a little bit different approach. They talk about diversified network income, resilience of the trade income, opportunities coming from the changes that's coming at the moment, or the volatility. And cost of risk increased just 23 million comparing to 150 versus HSBC. So that also will be something we're going to be questioning management during the earnings call today.
Yeah, and I got a sense of caution as well when I spoke to Sergio Motti of UBS on just that front. Their team, of course, coming through with a record quarter as a result of volatility in the market side. But he was certainly cautious in terms of what it means for capex spending, corporate investment going forward. What is your lens, with your analyst lens, on what is happening in around tariffs, the impact on banks? Where does that leave your view?
Well, there are two, let's say, channels, two impact of the tariffs and trade wars risk for banks. It's revenue and it's cost of risk. Not enough flows, not enough capex. Of course, it's affecting the bank's capital markets, financial market activity. Yes, 1Q was very strong because of the volatility, but what's going to happen in the second quarter, we don't know. Standard Chartered pointed out that the second quarter started quite strong as well for them, so there seems to be positive momentum. But is it sustainable? No, this is a very interesting question to understand the revenue trajectory in the next few quarters.
NatWest reporting 7 a.m. UK time. What are you watching for?
I would be watching definitely for net interest margin performance, revenue, strong revenue momentum with UK banks. Lloyds yesterday reported relatively strong NII, good revenue momentum because of the structural hedges. And we know UK banks, they have those structural hedges which are really distinguishing them from European peers. It's a very good revenue stream and it's supporting revenue for the next 2 years. It's supporting the ROTE guidance. So I believe that NatWest will maintain their ROTE guidance. Maybe they will top up as well some provisioning like Lloyds did for uncertainty coming from economic activities. We're going to look at exposure to U.S. tariff or to companies exposed to U.S. tariffs. That possibly they will discuss this as well. And mortgage war in UK, we know it is intensifying. And Lloyds yesterday confirmed that the spreads will be a little bit tighter because new price war is coming in the second quarter. But all in all, I think the story should be relatively positive as well.
Thank you very much indeed. Breaking down, Thomas, for us. What have we seen in terms of the earnings so far, the impact, of course, of tariffs, and looking ahead to NatWest and expecting some pretty decent numbers. They drop at 7 a.m. We'll see if that confirms, of course, your view. Thomas Nerzel, Senior Bank Analyst for Bloomberg Intelligence, with that analysis. Thank you. I'm now going to be speaking to the CFO of Standard Chartered. That's at 6:30 UK time, so in about 8-9 minutes' time. So stay tuned for that conversation as well. Now, some other stories making the news this Friday. In the UK, Prime Minister Keir Starmer's governing Labour Party has lost a parliamentary by-election to the Reform UK Party, led by Nigel Farage. Labour went into the election defending a majority of more than 1,400 votes at the seat near Liverpool. Among their safest, the 6-vote margin of victory for Reform was one of the tightest in British electoral history, if not the tightest, according to the BBC. And London luxury department store Harrods has reported hacking attempts just days after two other UK retailers said they were targeted. Harrods says it's taken steps to keep systems safe and has restricted internet access at its sites, but stores remain open. Marks & Spencer Group has recently been battling a cyber incident that rendered some of its systems inaccessible. And Moët Hennessy plans to cut its workforce down to 2019 levels as the wine and spirits division of luxury giant LVMH faces lackluster US demand and a tariff standoff between the EU and China. A company spokesperson told Bloomberg that the reduction in headcount would be achieved through natural turnover and not renewing vacant positions. Moët Hennessy has been facing headwinds after China imposed anti-dumping measures on cognac in retaliation to the EU's crackdown on Chinese EVs last year. Coming up, talking of EVs, Elon Musk marks 100 days of one of his biggest bets yet. We're going to look at his role working alongside President Trump and its impact in Washington and, of course, the impact on his companies. That is next. This is Bloomberg. Well, since Donald Trump returned to the White House, Elon Musk, of course, has been a scene stealer, gutting government agencies and sparking litigation. But Doge hasn't fully lived up to its billing, while Tesla has, of course, become collateral damage. That is the topic of our weekly doc.
The marriage of money and power is nothing new. But the arrangement between billionaire Elon Musk and President Donald Trump is like no other in the history of U.S. politics.
Come on up here, Elon. They're buddies. That's probably a good description, at least how Elon Musk sees it.
Donald Trump needs his fall guy, but he also needs the bulldogs, and sometimes they're the same person.
It's been a crazy 100 days.
You look around the U.S. government right now and you see friends and allies of Elon Musk in all these various departments, in all these various top leadership roles.
Trump has been able to get Elon Musk to help propel through all the changes that were spelled out in Project 2025, a blueprint for reshaping the government.
In Doge's mind, they have been wildly successful. And on the flip side, there is a cost to laying off federal workers, to fighting all of this litigation in court.
Musk is known for his uncanny ability to play a long game, but he may not have expected so much public blowback.
So Tesla's sales really dropped. Their first quarter sales were 13% lower than the quarter a year ago.
Starting in May, my time allocation to Doge will drop significantly.
As Musk pivots, the struggles surrounding Doge's actions continue, while many Americans are reeling from a tumultuous 100 days.
Musk isn't really leaving the Trump administration.
It's not like Doge is ending. I mean, Doge is a project that's supposed to continue until July 2026.
One thing we've learned over this last 100 days is that there is going to be a huge cost to Elon Musk for doing the things he's doing. He has basically taken his personal brand and tarnished it. And that's what happens when you put yourself front and center of some extremely controversial and often unpopular policies.
Okay, I'm going to switch focus in the next couple of minutes because Standard Chartered reports better than expected first quarter profit. I'm going to be speaking to CFO Giorgi. That's coming up next. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Stock futures gain on signs of a thawing in the US-China trade standoff. Beijing says it is evaluating direct talks with Washington. Cloudy forecast, Amazon says it is bracing for a tougher business climate in the coming months, while Apple slumps in late trade on slower sales in China and a warning on tariffs. Plus, Standard Chartered reports a first quarter profits beat driven by its financial markets and wealth units. We're going to be speaking to the bank's CFO in just the next couple of minutes. Let's check in on the markets then. European markets reopening, of course, after the holiday for most markets yesterday, and certainly on the front foot, being flagged by these futures gains of 1.3%. You're set for 8 straight days of gains for European equities if this plays out. You've already had that stateside. You could be on to 9 straight days of gains, which would be the longest rung in the streak we've seen for about 20 years for the S&P 500. FTSE 100 futures pointing to gains of 0.6%. S&P futures, again, looking to build on the upside of yesterday, up 0.7%. Nasdaq 100 futures looking to add 101 points, despite the disappointment coming through around the earnings from Apple and Amazon. Let's flip the board and have a look cross-asset. Non-farm payrolls dropping later today. Keep an eye, of course, on the unemployment rate. Top-line number expected to soften from the previous month, and average hourly earnings in focus as markets start to assess where the Fed goes from here in terms of that competition around inflation and the jobs market stateside. 422 right now on the benchmark 10-year, 113 on euro dollar. Brent trading at $62 a barrel, up 0.6%. And gold with some gains after the losses of yesterday, up 0.4% on the yellow metal. Let's get back to the earnings story with the lens, of course, on banks, because Standard Chartered's profit, as we mentioned, has beaten in the first quarter, driven by the bank's financial markets and wealth units. But the London-based lender is warning of the potential impacts from President Trump's trade war. Very pleased to say I'm joined now by Diego de Giorgi, CFO of Standard Chartered. Diego, thanks so much for joining us in the studio. Top line, good set of results. Let's focus on the here and now. What are you seeing in terms of the trade impact right now, the tariff impact on activity across the bank? How is that percolating through the numbers that you're seeing and have been seeing in recent days and weeks?
Absolutely. So, look, the recent results, as you say, this quarter are less in focus, but they clearly set us up very well for this environment that we are entering. Quarter after quarter of consistent results. You mentioned our financial markets and our banking business up in the double digits, but it's our wealth management business, which is truly a standout business and a leader in Asia, that is growing at almost 30% in Q1. And that is really interesting because obviously those clients give you a sense of how wealth management clients are reacting.
Do you see that 30% growth continuing in the quarters ahead within wealth?
So we indicate that we continue to see very long-term growth for this business in the double digits. 30% is very strong. We'll see how we do. What is very clear is that the activity has continued in wealth management, both from the point of view of sales, of net new sales, but also from the point of view of flows in the month of April, i.e. after April the 2nd, after seeing the April the 2nd effects. And it's really to the heart of what you're saying, of what we're seeing. It really exemplifies what we are seeing across our wealth business and also our corporate and investment banking business, which is clients are doing a lot of things in the short term. There is a lot of tactical activity. There is a lot of repositioning. There is a lot of taking care of exposures, whether it's to rates, to currencies, to commodities, as you mentioned before. And therefore, that activity is very high in the current volatile environment. And then the clients are evaluating what to do strategically going forward, and for that we will have to see how the current uncertainty evolves and hopefully continues to abate for them to decide to put in place more strategic activity.
Does that pace of activity, is that likely to be sustained?
So the pace is high now. This is an environment that changes every day. So it's clear that there is a question. But the long-term drivers of it remain very intact, and particularly in the wealth management business. Our type of wealth management, while we are active all across the wealth management spectrum, we are particularly focused on affluent customers. And affluent customers are really long-term savers. They have bancassurance products with us, mortgages, some funds, and we see that they are shifting toward more defensive products, but they remain active.
You're helping your clients. The volatility is a benefit. They come to you for that assistance. How do you compete? How do you balance that versus the competition of possibly a slowdown in trade volumes as a result of the uncertainty? Does one offset the other?
So, first of all, let's put into perspective that what we are really is we are a giant connector bank between our fast-growing regions in Asia, the Middle East and Africa and the rest of the world. Trade is important as an activity, but it's less than 5% of the revenues of the bank overall. So what we are really focused on is on, as you say, making sure that our clients continue to adjust either their financial lives, if they are wealth management clients, or really continue to diversify their supply chain. An activity that they have been doing for years, but that has clearly accelerated.
How much cross-border revenue, though, do you think is potentially at risk as you look out?
So we have in our results for this quarter, we've tried to be helpful to our investors and to our shareholders in explaining a little bit how our exposure across the network works. The reality is that our network is so diversified. The 175 years of investments and the 53 countries we operate in mean that the shifts are really shifts in direction, but the overall growth of the fastest regions of the world remains a structural trend that remains very powerful.
Are you seeing money flows moving? Are you seeing money flows moving in a substantial way out of the US to other jurisdictions?
Very interesting. We have asked ourselves this question and we've looked. We don't see evidence of real asset reallocation away from the US or away from the dollar. We are seeing it mostly, as I said, in the nature of the investments. The investments in the short term are becoming more defensive.
What are the best growth markets for wealth right now? Do you see inflows continuing at the levels they're at now? And where are the best growth markets when it comes to that unit?
Our most active markets continue to be the largest financial centers in our regions, which are fundamentally Hong Kong, Singapore, and Dubai.
But is there one that's standing out from the others right now?
Hong Kong has had a record quarter, so they're clearly doing very well. In terms of our corridors of wealth, but also of capital and of trade, all of the corridors going into the Middle East are particularly strong.
You and the team at Standard Chartered, you understand Chinese policy making very well. You understand that economy very well. Has the Trump administration miscalculated in their standoff with Beijing?
So China enters this situation, this uncertain environment, on the back of a period of relative slowdown in which the government had already started to deploy tools to help the economy. Those tools had been mostly monetary tools and mostly directed towards manufacturing. What is happening is that there is a continued shift towards helping the consumer. There is a continued ratcheting up of the measures that support the economy. And importantly, I would say, if you think about the world more at large, there's a couple of countries, of which China is one, Germany is another one, where the ability to pull the fiscal lever is very strong with the government, and China is one of them.
What is your level of confidence around credit impairments remaining at current levels as you push forward, whether it's in China or elsewhere on slower growth?
So the credit environment has been very good for us, and this quarter is the first quarter in 5 quarters that we report any net credit impairments in our corporate and investment bank, to give you a sense. Having said that, the credit cycle is a long cycle, and we are very much in the initial innings of an uncertain end situation. What gives us confidence in terms of where we will end is that whichever state the world will end in, the world will be definitely more complex. The world will have more need, our clients will have more need of our services, and our clients will want access to that unique asset that is our diversified network more and more.
It is complicated. There is that complexity. And yet you are committing to that $8 billion in terms of returns to shareholders by 2026. What is your level of confidence in that commitment? What potentially derails that?
So we are in uncertain environments, and that's why it's good to enter this environment with a strong balance sheet, with ample liquidity, with the profit generation engines. Because our profit generation engines are strong and continue to fire well, and we have already returned $5 billion out of that $8 billion in the first slightly more than a year of the 3 years that we have of time, we remain very confident.
You remain very confident in that $8 billion total. You've done $5 billion, you've got another $3 billion to go. When it comes to cost cutting, the Fit for Growth program, a lot of that cost cutting is going to come through, a lot of the action is going to come through this year. Where are you focused in terms of specifically meeting those targets? What additional changes are going to come through for the bank, and what does it mean for headcount?
So Fit for Growth has very much been a program of transformation. It has obviously good implications on the long-term cost trajectory of the bank, but it's really a program that aims to change the way that we do certain processes and a lot of the things that we do inside the bank and with our clients end to end. If I have to tell you what is the biggest change since a year and a couple of months that we announced it, is that AI is increasing its importance in a lot of the forms, in a lot of the efforts that we are putting in. And some of them are the more sexy efforts, the ones that go toward our consumers, our clients, but a lot of activity is what you don't see, and it's what is going on below the water internally in the bank in terms of how we use AI to power our processes.
Okay, so AI is real, and it's part of the Fit for Growth project for you. Additional cuts to jobs in the coming months?
We've never characterized Fit for Growth as a headcount program because we are naturally present across a very different environment.
It's part of the program, right? I mean, are we going to see further reductions in headcounts in coming months?
Look, as technology continues to evolve, the direction of travel for the banking industry is not toward an increase in headcount. But again, I would stress it's not one of the key focuses of Fit for Growth.
Okay. Diego, thank you very much indeed. On the back of a beat in terms of first quarter earnings and a view there in terms of the potential tariff impact and how clients are positioning. Standard Chartered Group CFO Diego Di Giorgi with the comments, of course, on the back of those earnings. Let's bring you the latest when it comes to the trade story with the specificity now around Temu, which, of course, is one of these e-commerce giants that ships into the US market. We know that the de minimis loophole has now been closed. That came through in the last couple of hours. So that below $800 rule has now been closed. So the likes, of course, of Temu and others, of course, Shein, another one, have to now hit and absorb those tariffs. They are now saying that they are and have recently transitioned their US operations to a local fulfillment model. This means all sales in the US are now being handled by locally based sellers. Temu's pricing for US consumers remains unchanged, so not changing their pricing for US consumers, at least for now. So that's the immediate reaction coming through on the back of that ending of the de minimis rule that came in a couple of hours ago. Now, some other stories making the news this Friday. President Trump says he will nominate Mike Waltz, his current national security advisor, to be the next US ambassador to the UN. The move sidelines Waltz, a top aide who drew a wave of criticism for inadvertently adding a journalist to a Signal group chat where officials discussed sensitive military plans. Marco Rubio is to serve as interim national security advisor while keeping his job as Secretary of State. And President Trump has imposed or has threatened to impose secondary sanctions on nations or companies buying Iranian oil. The move targets a major revenue source for Iran and comes as nuclear talks planned for this weekend are postponed. Sanctions could also further inflame tensions with China and the UAE, both of which buy petroleum products from Iran. Coming up, investors prepare for the crucial jobs report due out later today. We're going to discuss what to expect with Jane Foley, head of FX strategy at Rabobank, and how to position around the dollar. That is next. This is Bloomberg. Welcome back. Investors are turning their attention to US jobs data later today as S&P futures point to potentially a ninth straight day of gains. Let's bring in Jane Foley, FX strategist, head at Rabobank. Jane, thank you for joining us this morning. What do you expect to learn about the labour market of the US from the non-farm payrolls later today? Are you getting a sense, is the data telling you that we're starting to see a softness there? And how is that being factored in to expectations around the dollar?
We did see that yesterday, of course, in initial claims. And I think the market has been waiting to see this softness coming through. But in a way, that means that the risks to this data really, and I think this is for most US data over the last few weeks, has been sort of one-sided. Because if the data comes out better than expected, the market tends to think, well, this is sort of pre-tariffs numbers. It doesn't really count. And yet, if the data is to come in weak, the market will think, oh, yes, this is the start of this concern, that the elements of a recession building, could be seen in this data. So there is a one-sided risk. A softer data probably going to be taken a little bit more seriously than a stronger than expected number, if that's what we get. But there are, the expectations for this number do suggest that the market is expecting to see a slowdown in the US labour market.
The dollar is down about, 9% year to date versus the euro. All the kind of hand-wringing about the fundamentals of the US, the risk premium that needs to be priced in, some would say, to the US currency. Where does that conversation, or at least thinking within the markets, stand, do you think, in terms of questioning the role of the US dollar?
Well, I mean, we've had a lot of questioning about that over the last few weeks, and that will continue. And I think that will continue for the next few years, if not for the next 30 years. But, what is quite interesting, I think, over the last few sessions is, the dollar has made a little bit of a comeback, and that is probably related to a little bit more optimism. Well, obviously, you've got better sentiment in the stock market, and I think that is all linked with optimism that we may get some concessions on trade. And, within the next couple of months, and certainly before the end of June. Now, that I think is really important. And I think if we go back to when we saw the US administration announcing that 90-day delay on those larger tariffs for everybody except China, I think the timing of that was really important. And it's quite likely that we can assume that it was the shaky position of the Treasury market that really brought on the timing of that announcement. Now, if we do assume that, we can also assume that maybe, the US administration does not want to unleash the wrath of the Treasury market again. And that perhaps suggests that they are under pressure to announce some progress on trade deals with various different countries in the next, say, 4 to 6 weeks. And if that does happen, that can lift risk appetite and perhaps give the dollar a little bit of support. Because I think, a lot of the movements that we saw, particularly in euro dollar, they were so significant. We've already seen, dollar yen, move back again. And I think there could be a little bit of profit taking in long euro positions, and that can help give the dollar some support this quarter. However, if we look ahead to the possibility of recession, I think the dollar is on a weakening trend. And that is going to perhaps push euro dollar higher by the end of the year into next year. But I think in this quarter, we could see the dollar finding some support.
OK, that's really interesting in terms of the relative near term for the dollar versus the longer term on those recession risks. 113 right now on euro dollar. And you're suggesting then, at least in the near term, the euro's looking a little rich, Jane?
I think it is. I mean, if you think about, what drove that movement away from the dollar, since the Rose Garden tariff announcements, I think part of that was the change in stories for the euro. And we could also talk about the change in story for Japan too, a country emerging from 30 years of deflation. But if we look at the euro, then I think part of that movement into the euro from the dollar was driven by this expectation that, the US growth story is no longer the only game in town. Actually, what is Germany doing with its debt brake? The market had already seen that debt brake move as a game changer. And therefore, we did see the euro becoming much more in favour. And that was part of that story. But that perhaps is overdone. Germany could still see recession this year.
OK, yeah, Germany still has that recession risk, even with that fiscal spend expected to come through. The Bank of England, traders pricing in around close to 4 cuts, additional cuts from the BOE this year. The pound is at 133 versus the US dollar. Where does that leave your view then on sterling?
Well, I think against euro sterling, I think that's the important one. For 2 years, we saw sterling really outperform the euro. It was one of the second best performing currency last year and the year before. But I think that's something that has changed. And that is part of this change in the euro story. Because if the euro, really, if Germany next year perhaps and the year after really can boost growth through fiscal push, the UK doesn't have that. Our debt is far too high. If growth slows down, which it really could do because of these trade frictions, that could mean more tax cuts. And that could mean tax hikes. And that could mean the consumer is really restrained. So from that point of view, I think sterling really has lost its advantage against the euro. And I think euro sterling will probably trend higher over the next 12 months, not quickly, but perhaps a little bit slowly. And then where cable goes, well, I mean, obviously that depends very much on the volatility in the dollar. And we know that we're probably going to have quite a bit of that. So if the euro performs well against the dollar again into the end of the year, that could still drag cable higher. But I do think we've got sterling lagging the euro.
OK, euro dollar potentially higher in the months and quarters ahead. Jane Foley, making our Fridays as well, with the appearance of your dog behind you. Brilliant. FX strategy head at Rabobank with the excellent analysis there across the FX markets for us as we lead up to the non-farm payrolls data later today. Now to some other stories making the news this Friday. Airbnb shares fell in extended trading after the home rental company issued a weak outlook for the second quarter, citing softer travel demand. In the US, stronger gains in nights booked across Latin America and Asia Pacific helped offset the low single-digit growth of nights booked in North America, which accounts for about 30% of total bookings. Airbnb also pointed to, quote, softness in Canadian travel to the US. I wonder why. Eli Lilly's shares saw the biggest one-day drop since 2008 after CVS announced a plan to drop its blockbuster weight loss drug Zepbound from its preferred list. The move makes rival drug Wegovy, sold by Danish company Novo Nordisk, more widely available in the US. Eli Lilly maintained its sales guidance of between $58 to $61 billion for the year. However, investors who had been hoping for more explosive growth were underwhelmed. Plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Let's give you a preview then of the jobs data, the big macroeconomic number, of course, of the day. Later today, 1:30 p.m. UK time, out of the US. Non-farm payrolls expected to soften 138,000. That is the estimate, down, of course, from the previous number of 228,000. Look for the unemployment rate. That is expected to remain unchanged at 4.2%. But does that tick higher? And if so, how does that lead to expectations around where the Fed goes? Average early earnings are actually expected to tick up to 3.9% from the previous print of 3.8%. That would suggest there's still strength in terms of the wage growth and what that means for a consumer that is starting to look a little shaky stateside. So that's non-farm payrolls data later today. Let's flip the board and have a look at what's been happening in terms of the tech story, because that has really changed in the last 24 hours on the back of the earnings coming through from Apple and Amazon. Top line beats for both of them, but lift the hood, and there's some real challenges. The China sales data out of Apple, that continues to soften. That's a concern. Their services numbers weaker than some had expected. There are all sorts of unanswered questions for Apple, including the costs around tariffs. They put a number on that, $900 million US, but to what extent does that become an increasing cost for this business going forward? Not to mention the catch-up around AI. Let's check in on Amazon. Interestingly, for Amazon, AWS, in terms of the data centers, coming in below the estimates after the beats for Microsoft. That will be disappointing for some. Earnings per share, again, coming in above. That was a beat, but it's the current quarter where they guided lower than the estimates that led to the downside pressure on Amazon. Across the board for Mag7, again, top line, you've seen the beats coming through, but you've really had to dig into the numbers to see the idiosyncrasies coming through for these companies. The strength is arguably clearer and cleaner for the likes of Alphabet and Microsoft. Big question mark still, I would argue, around what is happening for Apple. Amazon, of course, with the supply chain hit on tariffs in focus. Coming up, and this is right at the end of the month, is NVIDIA on that AI catalyst. So that's the one to watch for next out of Mag7. Now, don't miss a new edition of the Bloomberg Weekend Newsletter, where you can get deeper analysis, feature pieces and profiles that provide unique insight into the latest news from around the world. The opening trade, though, is up next. This is Bloomberg.